All right. Welcome back, everybody. This is Industrial Insights. We have Chris Vassillian, our associate, who has been crushing it lately. And we have tenant frequently asked questions. We're thinking about what topics are most helpful. And so we went back to what are we hearing from our clients, from prospective clients, and from tenants that are in the market. And so the first one was we are dealing with a lot of firms that need office and may need a small warehouse component. And so Chris has been running with a couple of these, and it's challenging because you can look at office buildings, you can look at flex buildings, you can look at just having a little additional unit. So Chris, can you just go through a little bit of if you have a need for both, how do you look at it and what kind of options might you have available?
Yeah, so as you touched on, you can kind of fit within three different realms. So office, flex, and then traditional industrial. With a pure office option, you probably want to be on the first floor and build in suite some kind of storage component. And that'll make it a lot more convenient for employees to go back and forth and carry equipment in and out. And then you also want to make sure the landlord will allow that in the first place. And then flex is really where they should be. Industrial, flex is considered anything with 50% or more of it being office. So that's really where they should be. But then a lot of times they need 90% office. And office is expensive to build out. And so in that case, sometimes flex and industrial, where they probably should be, is maybe less cost effective. And then other times they'll just lease pure office and have an offsite self-storage facility where they can keep some of their equipment. So in general, you'll see this with engineering firms and where they have some handheld equipment that they need for job sites. And so those are a few different ways to kind of look at it.
And maybe trucks, or maybe a truck or two.
Mm-hmm.
And can you park it? Where can you park it? And how does it work with the landlord and the tenants?
Totally.
So flex deals are great because also part of the challenge is not all cities and markets have flex properties. Some just have like a regular industrial ones. And so geography probably plays a big, and like a submarket plays a big role. Then another one, renewals versus relocations. This is the other like topic du jour. And so where we are at in the market is that rents have softened in certain cities and size segments. And rents are higher than what tenants were paying in their last lease. And so right now that creates this weird situation where empty buildings, those landlords want to incentivize new tenants and new leases, and old landlords are slow to lower their rate to market if they don't have to or they perceive they have a captive audience. So Chris, what are some examples or challenges and solutions you have seen with some of these tenants we've been working with where they have a space, they have a renewal on the table, but the renewal doesn't quite fit or doesn't quite make sense where like a relocating actually is a real outcome?
Yeah, I mean, traditionally, you're going to get a slightly better deal on a renewal, right? Because your landlord's looking at it as not having tenant improvements, downtime, and so maybe they'll cut an existing tenant a better deal. Now, during COVID, during the craze, maybe that wasn't the case because landlords were fighting after the last dollar and they had the tenants to choose from in order to do so. Now that that's kind of turned, it really is specific on the space itself. So for example, if you're in 10,000 square feet and need dock high loading in Orange County, that's very tough to find. And so when you can, you kind of want to work both angles, right? And so on the renewal, you're saving on the moving costs, installing new racking, the downtime or moving the operation. So there is some savings there. But with a new option, we were able to negotiate a bit more free rent to offset those costs. So at the end of the day, it's a math equation, and you really don't know what the numbers are on either side until you've explored both paths. So we always recommend in those situations to work both paths. And then once you get to best and finals on each, that's when you can kind of make a decision. And that gives you as the tenant the most amount of leverage in the circumstance.
Yeah. The rule of thumb used to be you don't change buildings if you're not changing the size of the building, right? Like you don't move just for savings, where now maybe people are scrutinizing their footprint a little bit more. And with that delta, maybe it does make sense a little bit more often than it used to.
Yeah, I would say racking systems too. You can get away with like a 50-inch aisle now. And so it's become a lot more compact, and there's new forklifts and ways to kind of move product in and out. And so if you can leverage material handlers to get more efficient within an existing warehouse to increase capacity or shed off some space. In infill Orange County, when rents are just call it $2 gross on average for dock high space, if you can shave 4,000 square feet, that's 8,000 a month to your bottom line. And so as an entrepreneur, I mean, saving 100 grand directly to your bottom line is worth, call it the $30,000 upfront investment in that racking system that'll last you for 5 years. So that's one consideration with optimization.
Answer of the day, Chris. That was a good one. Yeah, it's depending on when you racked your building last versus what you would rack it at if you were to relocate might be drastically different answers and outcomes, and cause there to be a bunch of savings that maybe you had not realized and wouldn't realize had you not thought about moving as an alternative or like a viable alternative.
Yeah, pallet positions, that's the key metric to track.
Yeah. And so if I'm Chris's client, I'm asking Chris on the phone, aren't rates going down? Are rates going down? And so what's the answer to that? Are they?
They are. It's
Why
kind of
aren't they going down for me? Right? Is kind of the follow-up question for certain people.
yeah, it's so size driven because in the smaller product, you've been seeing less of a change. There's still been good activity and demand, especially with the trend of people downsizing. That's kind of supporting the demand for some of the smaller spaces, call it 20,000 square feet and below. On the bigger spaces, and then especially in the Inland Empire, that's where you're seeing a lot more of the softness. And then one lesson that I've learned the hard way is different ownerships and their capital structures allow them to bend to different degrees. And so you can have two 50,000 square foot buildings down the street from one another, exactly the same asking rate, exactly the same vintage and everything. And just their capital structure alone will allow one to get to a lower rate than the other, and for your tenant to get a better deal at one building. So that's one factor to consider. But at large, rates have softened a bit, not dramatically, I would say, especially in infill Orange County. In the Inland Empire, you'll see more of the 15, 17% declines in rates. And then a lot of buildings that are TBD, and during COVID, that was who's going to pay me the highest offer, are now TBD of we'll do a market-driven deal, which is changing by the week and changing by the month based on comps trending and declining. So that's been a good one to see of the TBD kind of working or cutting both ways depending on market direction.
Yeah, what does withheld or TBD mean was maybe a question you brought up that we didn't come up with, and there's a great one. Yeah, it means spot pricing, and it used to mean bad spot pricing, and now it means maybe good. Yeah.
Yep. It means bring me an offer and we'll get you a counter.
Yes. And then you had a question for me.
I did. Why is free rent always tacked on the back end of a lease term? It's something that's customary and always in there. And just the explanation of why that is something that's eluded me, and I was hoping you could expand on.
Yeah. It was not normal for me when I got in the business, 2004, although it was on occasion, maybe like 10 or 15% of the times. And so for people listening, if you have a 5-year lease that you're negotiating and you're getting 2 months of free rent, when you're writing the lease, you used to say, okay, this is 60 months and the first 2 months are free. So first 2 months are free, and then you pay rent for 58 months. And so 2 are free, 58 are paid, 60 total. What you see is what you get. And so over time, it has turned into, if you are doing a 5-year lease with 2 months free, you do a 62-month lease. So you get 2 months free, and then you have 60 months of term. And why is it? It no doubt has become commonplace where it is now 95% of the comps you look at, like the term has been added back on. I was always told it was like a lenders or it was public companies, that they needed to report to their investors that they got like the full 5-year term. And that it was like a reporting thing. But as more time has gone by and I listened to like all of the SEC earnings reports, like they talk about giving free rent. It's not like free rent is like something that you're hiding or you're not reporting. It all ends up on the financials, right? And cash flow. And so is it just like a way at the margin to improve your cash flow and your operating, like your returns? I would think it would be. Like, why wouldn't you? The flip side of that, I think, is if you're a tenant, I wouldn't feel bad about it. Like where you think of like a lot of tenants' initial gut reaction is, I still got to pay 5 months worth of rent, therefore I did not get a concession. And so I don't view it that way in the sense of you are getting the space and using it for your business and making money out of it and not paying for being there. Are you not? And you are, regardless of whether you're there for 58 months or for 62 months. So I think the logic's a little murky, but like I don't find lenders are like, oh my gosh, you did 58 months of rent is coming in, not 60. Therefore, your terms are different. Or like I don't see it like a affect capital structure. So I think it's just the institutionalization of the business and the IRR-driven spreadsheet analysts realizing there's like 0.02% returns in there and like why leave that on the table. But if you are getting the use of space for cost-free, like I find few people in 5 years are too mindful of like, I had to stay 2 more months, and that's a big upside or downside for that.
Right. And so if you say it's, if your tenant tells you it's not a concession because I'm paying in 5 years those extra 2 months at a higher rate after the annual increases are factored in,
Ooh, sure.
I think, yeah, another way to reframe it for them is, well, in 5 years down the line, you're going to be paying rent somewhere else, right? Those 2 months tacked onto the back end are what you would have to pay even if you relocated or signed a new renewal, right? And so it is interesting. It is a concession after all and helps with your moving costs and setup costs. But sometimes, the word free rent isn't quite as it would make you believe. There's a few nuances to it.
In the writing of the lease, sometimes you'll see people do 12 months, 12 months, 12 months, 12 months, 12 months of rent schedule and not have that bump at the end and not have the 2 months of free account for rent being paid in the rent schedule. So I think that's something that's probably negotiable. It's probably
Mhm.
more the latter, but it's also landlords write leases. So of course they're going to write them that way. But it's funny, is that a black and white or is that gray? And it's like a darker shade of charcoal, I would say.
Yeah. And then we had a case as well where operating expenses are also negotiable. So oftentimes, free rent by default excludes operating expenses. During those months on a triple net lease, their base rental rate is abated, but operating expenses will still be due. But in a lease that we recently negotiated, we were able to abate the operating expenses too. And so I think that was a unique circumstance that maybe is 20%, but something to keep in mind when you're negotiating your next lease as a lever to pull.
Yeah, 20% in today's market. Yeah.
Maybe less. It's definitely infrequent, but something that you can ask for. But traditionally, free rent has the tenant still paying operating expenses on a triple net lease.
Good insights. So if you're a tenant out there, those are a lot of what people are asking about and wondering. Hope that provides some clarity, and we'll be excited to see you again next week. Have a good one, everybody.
Thanks, everyone. Have a good Friday.
Yep.